Hi everyone, this is the post-market analysis for Thursday, September 19th. So we had 8:30 unemployment claim news. The previous day we had Fed funds rate. So because of that, the NASDAQ, S&P, they were running up because the Fed funds rates is good for the stock market. The outcome. So the stock market was rallying. So the stock market was rallying up after the news. So if you look at the daily chart, we posted in the group for the team that we expected this price run to be up for a couple of reasons. One, you can see this relatively equal highs over here, this red line. So the price broke these relatively equal highs over here as well, and after the price started rallying up, after breaking, when the price was rallying up, and due to the Fed funds rate being helpful for the stock market to rally, and also relative highs, and you can see a fair value gap here. So the daily bias was bullish due to those reasons. So we were looking at the market to take long entries, bullish entries. So looking at the hourly chart, we had a fair value gap here. If you look here, 1 hour fair value gap and a 1 hour order block. You could see them over here, the order block. The order block over here, and the fair value gap over here as well. So we were expecting the price to come down to this fair value gap and then to rally. We were expecting, let's say, something like this, from somewhere onwards, the price to come and then to take the liquidity, this daily relatively equal highs liquidity. However, it didn't happen. The price rallied straight away. So if you look at this, the price rallied straight away, right? The reason was the Fed funds rate being released yesterday. Because of that, the market continuously kept rallying, and market took that relatively equal high. So this was the target for the day. And if we are to take a, if you were to take an entry, your target was this, and you were to take an entry somewhere at the New York Open New York session 9:30, somewhere here, and then to target over here. So that was the goal for the day. Then going into 15 minutes chart, you can see this is the New York midnight open, and the price has continuously kept rallying due to the reasons I mentioned. And this is the New York AM session. So we were looking over here to take an entry. So now when we look over here, you can see the New York midnight open is down here. So usually if you look at the power of 3, it's good to take entry just below the New York midnight, but due to the rallying, due to the Fed funds rate, the price was way above the midnight high over here. Then we got the 8:30 a.m. opening price over here. So on this day, you could have looked at relatively to New York 8:30 open price, like, because it was rallying a lot for the power of for the power of 3. So somewhere here, like you can see, the price came down. So possible entry, but a quick entry targeting these relatively equal daily highs. A quick entry could have taken somewhere here if the other factors were aligned. So the reason why we could have taken entry here, even though the price is above the New York midnight, is one thing is the daily bias, as I explained earlier, liquidity, relatively equal highs, and the fair value gap. Basically, if I take you back to the daily chart, so the fair value gap, liquidity residing over here, the fair value gap and the daily bias and the Fed funds rate day before yesterday, that's also rallying. So due to those facts and after the Fed funds rate, the market kept going higher. So due to those, even though the price was way above the daily open for the power of 3 midnight, we could have looked for a quick entry targeting these relatively equal highs. And then you can see after 9:30 a.m. open, there is a quick liquidity grab. This price came down to grab the sell side liquidity residing down here. So that's a positive sign for us if you were to take entry. And if you look at SMT divergence, there was not really a SMT divergence, but if you look at 9:50 time, you can see if you look over here, this point, and if you look from here to here, you can see relatively S&P was accumulating longs a lot, whereas NASDAQ shows strongness over here. So due to that also can be taken as a fact, the strongness of NASDAQ and S&P accumulating longs, even though there's no real visible SMT divergence, that is also a confluence. Okay, so with that idea, if you are to take a trade, you need to go to the 5 minutes chart. This is 15 minutes. If you go to the 5 minutes chart over here, now this is that liquidity grab, but then we can't still take an entry. You could have taken aggressive entry due to all those facts. But it will be a very high risk entry if you took from this point, right? Without the displacement. If you have to take a conservative entry, you have to wait for the displacement. Now the displacement happened. If you look at the 5 minutes chart, it happened, and then you can see the displacement happen. Then there is a fair value gap over here if you look at this point. However, the price came to the fair value gap after 11 o'clock. So we usually take trades from 9:30 to 11 like entries, but because it came after 11, we did not take that entry. But if one took the entry, yes, it would have run to the target. However, another reason is not only that, the liquidity already was taken over here. Still, that would have been fine if it came to the fair value gap during 11 o'clock. But ideally, if the liquidity was not grabbed, ideally what we were looking for was a displacement and then coming to a fair value gap, right? Somewhere like into a fair value gap after the displacement, let's say into some form of fair value gap, and then to go for our price target. And then ideally we were looking for taking a long entry, hypothetically I'm telling, but you had to look for a 1 to 2 risk to reward. This is hypothetically I'm telling, that was the possible scenario, but it didn't happen, so we did not take a trade. So even though our analysis was correct, let's check it. We did not take an entry due to not seeing the displacement and the fair value gap in that time frame. However, high risk entry could have been taken, which is okay on a day like this, but you had to expect lose, like high risk of losing that entry as well. However, that was how the AM session played out. Okay, then looking at the New York PM session, post market analysis, you could see after 1 o'clock, after lunch, you can see the grab of liquidity and a huge displacement to the downside and a shift of market structure over here. So this, and it's towards, like it's the PM session. So the market was rallying the whole day. If you look here, if I just bring it slightly over here, starting from midnight, if you look here, okay, we need to go a little bit over here. So if you look the whole day, starting from the midnight open time, the price was rallying the whole day till the PM session. So there is a chance that if I undo this quickly, there's a these are game of probabilities, right? So there is a chance, because it was rallying the whole day, and if you see this displacement, which I showed now, there is a chance then the price to retrace a bit at least to grab liquidity of, let's say, the yellow color box, or let's say the green, but at least the first target would be the liquidity residing below this yellow color area, the lunchtime area, but there's some liquidity over here. So that's what happened actually. Let's see how you could have taken, whether you could have taken entry or not. Let's have a look at it now. So with that idea, seeing the price already taken the relatively equal high liquidity, the daily, and going to the fair value gap, daily fair value gap, and the price rallying the whole day as mentioned, and now seeing after the lunch time, seeing this liquidity grabbing the liquidity series over here, and this huge displacement down. So seeing that, then we could look for entry if we see the price, let's say after this, if the price reaches a fair value gap. Let's see there's a fair value gap here, there's a fair value gap here. At least if the price reach this fair value gap, or let's say if the price reach this fair value gap, or this one. But as you can see, the price did not retrace to any of these fair value gaps in price imbalances. So then one could have missed this entry because it didn't come. But if you look a little bit detail, let's check a little more detail. There were, well, if you look at the price comparison of Dow, NASDAQ and S&P at that time, which is at 1445, 1440, you can see, excuse me, I'll just slightly show it to you. You can see at that time, the Dow came to its 5-minute fair value gap, as you can see over here, where I move my mouse. So the Dow came to the 5-minute fair value gap, but as I showed you, the NASDAQ did not come into its fair value gaps. As you can see over here, it didn't come to its fair value gaps. So if you look at, because these markets move relatively the same way, like, so if you see the Dow coming to the fair value gap, and then you can see price pushing down soon after that, I mean at this point. So based on that, one could have taken the entry in the NASDAQ. If you are just trading only NASDAQ, right? If you are trading Dow, you would have taken the trade on the Dow. But if you are trading only NASDAQ, you could have still taken the trade from the NASDAQ, but that will be based on the Dow coming to the fair value gap. So in that case, if you look over here, your entry, and also you could think like as if if you take the drawing, you could think as if the NASDAQ is kind of respecting this up candles over here. You could think as if it's respecting, if you think it in terms of a slightly higher level order block, if you think this as a bearish order block from taking it from a higher level, I'm just giving the idea hypothetically, then you could think as NASDAQ is respecting the order block. Like you could think like as a if you are to take that entry as a confluence. So what I mean is basically you could then think, okay, these are the candles of that order block. If you are take, but actually if you look at the 5 minutes, this will be the order block. This green, the last green you see will be the order block candle. But what I'm telling is, if you look at it from a higher time frame order block, such as the 15 minutes. Now I'm in the 15-minute chart. You can see this is that. In that case, this will be the order block candles, these three green candles at 15 minutes. So the same thing was what I was showing in the 5 minutes at the 1440 time. Over here, when the price was coming to this, compared to Dow also coming to the fair value gap at 1440, somewhere here, you can see that 15-minute order block is kind of like respected. So if you think like that, one could have taken an entry over here, right? But this will be a short entry, thinking the price would come back to the daily range after a rallying whole day. So 1440, after seeing that in the Dow, one could have taken an entry over here, right? But then you have to see if you have the risk to reward, right? So if you are to take that entry, then at least you are targeting the liquidity below this, right? And then at least you need, let's say, 1 to 2 risk to reward. Okay, so then you could potentially take an entry like this, thinking the price would respect this 15-minute order block candles, plus based on the fact that at 1440 over here, the Dow coming to the fair value gap, and with all the other factors explained little while ago, one could have taken an entry expecting the price to respect your stop loss, right? But we did not take these trades, but some of our team members took these trades. But having said that, even though we explain it like this to you, it doesn't mean you have to take all these trades, right? Why we explain these concepts to you is so that you understand the ICT concepts, and when you have to apply these concepts, you have to be applying them very carefully with all these extra confluences. But keep in mind, it's a game of probability. Any of these trades can be a losing trade as well. Even though I showed you one morning example and now evening example, like possibilities, one high risk entry in the morning and now this one, both of them could be losing trades as well. Okay, so that's it for this recording, and we will see you in another recording soon.